Code 3 American is going to go over a quick example and an illustration showing why a syndication or why it may make sense to do syndication as opposed to just one investment in your own account or a couple investments. Because syndication is just bringing together resources for folks to kind of share risk and reward. And so I'm going to illustrate how that may look. So let's say we got an example investor, and that example investor wants to buy either one fourplex or two houses. And let's say they're deploying $500,000. In that case, they have a choice. If it's one fourplex, it goes in one LLC, maybe two houses, they either put it in one or two LLCs. And this would be for asset protection purposes, so that if something happens in one structure, and say this house is owned by this LLC, a tenant falls down the stairs and sues, they shouldn't be bleeding into this structure. So there's some compartmentalized protection there. So let's say they paid 500,000 cash on the two houses or one fourplex. And let's just say, let's not talk amortization or tax benefits or any of that. I'm just trying to make a really simple point that let's say 6% cash on cash return on the 500,000 is 30,000 a year. Here, if one tenant moves out, we're between, this is actually incorrect, 25 to 100% vacant. It'd be 25% on a fourplex. And it could be, if one tenant moves out on single family, depending if you own one or two, it could either be 50 or 100% vacant. So economies of scale aren't going to be there on just one or two houses. Whereas now, let's say you took the same $500,000 and you went and you bought one 12-unit apartment building in your own account, 20% down, you get a $2.5 million asset. Regardless, 6% cash on cash is still 30,000 on the same 500,000 invested. Still probably don't have economies of scale, but we do have the benefit if one tenant moves out. Now we're only about 8% vacant. So let me show you another side. Let's say that same investor goes out and acquires investment interests in five different properties that may be spread around five different markets. And therefore, if job changes happen on this side where there's only one or two units, it could really affect occupancy. But if these assets are all owned in different markets, they're subject to the risks of different markets, therefore diversified. Same thing for weather risk, tornadoes, earthquakes, whatever the case may be. Much less likely all these get wiped out as opposed to this side, which I'll show in a second. So again, let's say the same 500,000 is deployed, 6% cash on cash is still 30,000 a year, but we have the benefits of diversification across multiple markets, so we're sharing and spreading out the risk. And this is what I like about syndication. Not only do you share the fruits, but we can all share in spreading the risk across more things. It's kind of like a mutual fund in Wall Street instead of owning one stock. Kind of the same concept. And if one tenant moves here, it's a very, very small percentage of vacancy. So let's say something bad comes along. Let's say a weather event, a natural disaster or something in this case. If it hits your 12-unit apartment building with a tornado, it could be 100% loss. If we hit this side, it could be between half and full loss, depending if it hits one or two buildings. If we hit this side, we may only have a 20% loss. And so again, we're spreading risk. So not only do private placement syndication just means bringing those resources together. It allows us to reach for things that maybe none of us could reach for individually. Some people bring the capital, and some people bring the time, talent, relationships, and work effort. And when you put all that together, suddenly you can do things as a group that maybe you couldn't do individually. But you also not only share the rewards, and here we're just talking cash on cash, but tax benefits, appreciation, amortization, all those things. Not only do you share the rewards, but you share the benefit of diversifying risk and spreading them out across uh, a broader area, I guess. So a number of things. I just used real estate here as an example, but development deals, whether it's land development or vertical construction, energy, agricultural land, whatever, a number of things can be done. So how do you do that? I did another video that talks about how syndications are structured, just kind of illustrates just kind of like this did, how they're actually put together, and it talks about accredited versus non-accredited investors. First thing you want to do is join communities and get around people to where you can build relationships so that you can even hear about deals that are going out for non-accredited investors. One way you can do that is you can get a free copy of Next Level Your Life. Tells a little bit more about my journey. I was given the opportunity to co-author some of that. Some amazing folks in this book. And you can just get that by sending an email to nextlevel@code3assets.com. Again, nextlevel@code3assets.com. You'll also end up on our Mission Brief newsletter list where we send out information based on the economy, different markets, different deal structures, things like that. And that's a great way to start building relationships so that you can participate in things like what we talked about today if the relationships fit for everybody. So, with that, we'll catch you next time. Teams up.